everyone. Today we are talking about technical analysis. So, what is it? Technical analysis is a tool or method used to predict the probable future price movement of a security, such as a stock or currency pair, based on market data. The theory behind the validity of technical analysis is the nothing that the collective actions, buying and selling of all the participants in the market currently reflect all relevant information pertaining to a traded security and therefore continually assign a fair market value to the security. Past practice as an indicator of future performance. So technical traders believe that current or past price action in the market is the most valuable indicator of future practice action. Technical analysis is not only used by technical traders. Many fundamental traders use fundamental analysis to determine whether to buy into a market, but having made that decision, then use technical analysis to pinpoint good, low risk buy and try price levels. Charting on different time frames. Technical traders analyze price charts to attempt to predict price movement. The two primary variables for technical analysis are the time frames considered and the particular technical indicators that a trader chooses to utilize. The technical analysis time frame shown on chart range from 1 minute to monthly or even yearly time spans. Popular time frames that technical analysis most frequently examine include 5-minute chart, 15-minute chart, hourly chart, 4-hour chart, and daily chart. The time frame a trader selects to study is typically determined by both individual traders' personal trading style. Intraday traders who open and close trading position, and within a single trading day favor analysis price movements on shorter time frame charts, such as the 5-minute or 15-minute charts. Long-term traders who hold market positions overnight and for long periods of time are more inclined to analyze markets using hourly, 4-hour, daily, or even weekly charts. Price movement that occurs within a 15-minute time span may be very significant for an intraday trader who is looking for an opportunity to realize a profit from price fluctuations occurring during one trading day. However, that same price movement viewed on a daily or weekly chart may not be particularly significant or indicate for long-term trading purposes. It's simple to illustrate by viewing the same price action on different time frame charts. The following chart for silver shows price trading within the same range from roughly 16 to 18 that it's been in for the past several months. A long-term silver investors might be inclined to look to buy silver based on the fact that the price is fairly near the low of that range. However, the same price actions viewed on an hourly chart shows a steady down state that has accelerated somewhat just within the past several hours. A silver investors interested only in making an intraday trade would likely shy away from buying the precious metal based on the hourly chart price actions. Candlesticks. Candlestick charting is the most common used method of showing price movement on the chart. A candlestick is formed from the price action during a single time period, for any time frame. Each candlestick on our chart shows the price action for 1 hour, while each candlestick on 4-hour chart shows the price action during each 4-hour time period. Candlesticks are drawn or formed as follows. The highest point of a candlestick shows the highest price a security traded at during that time period, and the lowest point of the candlestick indicates the lowest price during that time. The body of a candlestick is respective red or blue blocks or thicker parts of each candlestick as shown in the charts above. Indicates the opening and closing prices for the time period. If a blue candlestick body is formed, this indicates that the closing price on top of the candlestick body was higher than the opening price, the bottom of the candlestick body. Conversely, if a red candlestick body is formed, then the opening price was higher than the closing price. Candlestick colors are arbitrary choices. Some traders use white and black candlestick bodies. This is a default color format and therefore one of the most common used. Other traders may choose to use green and red or blue and yellow. Whether colors are chosen, they provide an easy way to determine at a glance whether price closed higher or lower at the end of a given time period. Technical analysis using candlestick charts is often easier than using standard bar charts, as the analyst receives more visual cues and patterns. Candlestick patterns, dodges. Candlestick patterns, which are formed by either a single candlestick or by a section of 2 or 3 candlesticks, are some of the most widely used technical indicators for identifying potential market reversals or trend change. Dodgy candlesticks, for example, indicate indications in the market that may be a signal for an impending trend change or market reversal. The singular characteristic of dodgy candlestick is that the opening and closing prices are the same, so that the candlestick body is a flat line. The longer the upper and lower shadows or tails on a dodgy candlestick, the part of the candlestick that indicates the low to high range for the time period, the stronger the indication or market indecision and potential reversal. The typical doji is the long-leashed doji, where price extends about equally in each direction, opening and closing in the middle of the price range for the time period. The appearance of the candlestick gives a clear visual indication of indecision in the market. When a doji like this appears after an extended uptrend or downtrend in market, it is common interpreted as signaling a possible market reveals a trend change to the opposite direction.